Question 1. Scenario-based question. Topic: Formation of captive insurance companies. Sarah owns a mid-sized manufacturing company and wants to reduce her dependency on traditional insurance. She is considering forming a captive insurance company in Oregon. She consults an advisor who recommends conducting a feasibility study. Sarah is unsure what should be included in this study. Which of the following elements is most critical to determine the viability of forming a captive? A. A comprehensive analysis of her company's risk exposure and loss history. B. Identification of potential reinsurance partners for risk sharing. C. Detailed examination of Oregon's licensing process and timelines. D. Evaluation of available capital to meet minimum surplus requirements. Answer A. A comprehensive analysis of her company's risk exposure and loss history. Explanation A. Correct. A feasibility study must prioritize understanding the company's risk profile and loss history to ensure that forming a captive is financially and operationally viable. Without this analysis, determining appropriate coverages, retention levels, and premium calculations is impossible. Being correct. While identifying reinsurance partners is important, it is a subsequent step after confirming the captive's viability. It is not the first priority in a feasibility study. C. Incorrect. Knowing licensing timelines is procedural and important, but secondary to assessing the company's fundamental risk profile. D. Incorrect. Although capital requirements are crucial, they are assessed after confirming that a captive can address the company's risk needs effectively. Relevant guideline. Oregon Insurance Code emphasizes the importance of feasibility studies in assessing risk, financial viability, and alignment with regulatory requirements. Question 2. Topic: Risk management and coverage. Which of the following risks is least likely to be effectively managed through a captive insurance structure? A. Cybersecurity breaches affecting customer data. B. Catastrophic natural disasters causing widespread damage. C. Workers' compensation claims for minor injuries. D. Product liability claims from defective goods. Answer B. Catastrophic natural disasters causing widespread damage. Explanation A. Incorrect. Cybersecurity breaches are an emerging risk that captives often address due to high premiums in the traditional insurance market. B. Correct. Captives are generally not suited for catastrophic risks because such events require substantial financial reserves or access to robust reinsurance markets. Most captives are designed to handle predictable and moderate risks. C. Incorrect. Captives frequently manage workers' compensation claims, especially for minor or predictable injuries, as part of their risk management strategy. D. Incorrect. Product liability claims are often insured through captives, particularly for industries with consistent exposure to such risks. A relevant guideline. Oregon-specific reinsurance rules highlight the importance of reinsurance for catastrophic risks that exceed a captive's financial capacity. Question 3. Topic: Financial and accounting principles. A captive insurance company prepares its financial statements based on statutory accounting principles (SAP). Which of the following is a key difference between SAP and generally accepted accounting principles (GAAP) as it applies to captives? A. SAP emphasizes the matching of revenue and expenses over multiple periods. B. SAP focuses on ensuring solvency by emphasizing the valuation of assets and liabilities. C. Under SAP, all investments are reported at fair market value, while GAAP allows historical cost valuation. D. SAP requires deferred acquisition costs to be capitalized, unlike GAAP. Answer B. SAP focuses on ensuring solvency by emphasizing the valuation of assets and liabilities. Explanation A. Incorrect. Matching revenue and expenses over multiple periods is a principle of GAAP, not SAP, which is more focused on solvency and liquidity. B. Correct. SAP is designed to ensure that insurance entities, including captives, remain solvent by valuing assets and liabilities conservatively. This focus protects policyholders. C. Incorrect. SAP may require investments to be valued differently depending on their classification, but not all are reported at fair market value. GAAP provides more flexibility in asset valuation methods. D. Incorrect. GAAP allows the capitalization of deferred acquisition costs, while SAP typically requires more immediate expense recognition. Relevant guideline. Oregon's financial reporting requirements for captives align with SAP standards, prioritizing solvency and regulatory oversight. Question 4. Topic: Management and operations. Which of the following best represents the fiduciary responsibilities of a captive insurance company's board of directors? A. Maximizing the captive's profits for the parent company. B. Ensuring compliance with all regulatory requirements and protecting policyholders' interests. C. Designing and approving risk management programs for the parent company. D. Approving underwriting guidelines and premium levels. Answer: B. Ensuring compliance with all regulatory requirements and protecting policyholders' interests. Explanation: A. Incorrect. While profitability is important, it is not the primary fiduciary duty. The board must prioritize compliance and solvency. B. Correct. Fiduciary responsibilities focus on safeguarding the captive's solvency, regulatory compliance, and policyholder protections. These are fundamental to maintaining the captive's operations and ensuring regulatory confidence. C. Incorrect. While the board may review and oversee risk management programs, this task does not constitute their fiduciary responsibility. D. Incorrect. Approving underwriting guidelines is an operational task, not a fiduciary duty. Relevant guideline: Oregon-specific statutes emphasize the board's responsibility to ensure the solvency and regulatory compliance of captives under their governance. Question 5. Scenario-based question. Topic: Audits and examinations. David is the CEO of a captive insurance company domiciled in Oregon. During an annual regulatory audit, the examiner discovers that the captive's financial records do not reconcile with its statutory filings. What is the best course of action for David to ensure compliance and avoid penalties? A. Submit a written explanation for the discrepancy and request leniency. B. Immediately amend the statutory filings and notify the Oregon Division of Financial Regulation. C. Request an extension for the audit to conduct an internal investigation. D. Provide supplementary records during the audit to justify the discrepancy. Answer: B. Immediately amend the statutory filings and notify the Oregon Division of Financial Regulation. Explanation: A. Incorrect. A written explanation without corrective action does not resolve the issue or demonstrate compliance. B. Correct. Promptly amending filings and informing the regulator demonstrates good faith, transparency, and a commitment to compliance. These actions align with Oregon's regulatory expectations for captive insurers. C. Incorrect. Extensions may not be granted for such issues, and delaying corrective action can result in penalties. D. Incorrect. Providing supplementary records may not address the root cause of the discrepancy or ensure future compliance. Relevant guideline: Oregon's insurance code mandates timely reporting of accurate financial information and requires immediate corrective action if discrepancies are identified. Question 6. Topic: Risk management and coverage. Which of the following strategies is most effective for a captive insurance company managing fluctuating annual claims costs? A. Establishing a robust risk retention strategy with no reinsurance. B. Purchasing stop-loss reinsurance to cap total claims exposure. C. Increasing premium rates for the parent company to build reserves. D. Creating a protected cell within the captive to isolate risks. Answer: B. Purchasing stop-loss reinsurance to cap total claims exposure. Explanation: A. Incorrect. While a strong risk retention strategy is useful, it leaves the captive vulnerable to significant claim fluctuations. B. Correct. Stop-loss reinsurance provides financial protection by capping claims exposure at a predetermined threshold, allowing the captive to stabilize costs. C. Incorrect. Raising premium rates may strain the parent company financially without directly addressing claims variability. D. Incorrect. Protected cells are more suitable for isolating specific risks but do not address fluctuating claims across the entire captive. Relevant guideline: Oregon-specific reinsurance rules encourage captives to use reinsurance strategically to manage financial stability. Question 7. Topic: Legal and regulatory framework. Under Oregon law, which of the following is a key requirement for obtaining a captive insurance license? A. The captive must demonstrate sufficient reinsurance agreements in place before licensing. B. The parent company must be headquartered in Oregon. C. The captive must submit a detailed business plan to the Oregon Division of Financial Regulation. D. The captive must have at least 3 directors, all of whom must reside in Oregon. Answer: C. The captive must submit a detailed business plan to the Oregon Division of Financial Regulation. Explanation: A. Incorrect. Reinsurance agreements are important but are not a prerequisite for licensing. B. Incorrect. The parent company's headquarters location does not restrict the formation of a captive in Oregon. C. Correct. Oregon law requires captives to submit a comprehensive business plan detailing operations, risk management, and financial strategies as part of the licensing process. D. Incorrect. There are no residency requirements for all directors under Oregon law. Relevant guideline: Oregon's licensing procedures are outlined in the state's captive insurance regulations, emphasizing detailed business planning. Question 8. Topic: Emerging trends and challenges. What is one of the main challenges captives face in managing cyber risk insurance policies? A. Difficulty in complying with Oregon's solvency requirements for cyber coverage. B. Lack of actuarial data to accurately price cyber risk premiums. C. Restrictions on cyber risk reinsurance availability in Oregon. D. Limited ability to include third-party risks under captive policies. Answer: B. Lack of actuarial data to accurately price cyber risk premiums. Explanation: A. Incorrect. Oregon's solvency requirements are broad and do not specifically target cyber risks. B. Correct. Cyber risks are relatively new, and the limited actuarial data creates challenges in setting accurate premium rates and reserves for potential claims. C. Incorrect. While reinsurance may be limited, this is not as significant a challenge as pricing due to data scarcity. D. Incorrect. Captives can underwrite third-party risks, but this does not inherently limit cyber coverage. Relevant guideline. Oregon's regulatory framework encourages captives to incorporate emerging risks like cyber liability while addressing data challenges through actuarial expertise. Question 9. Topic: Financial and accounting principles. A captive insurance company in Oregon reports its assets using statutory accounting principles (SAP). Which of the following is most accurate about SAP's treatment of assets? A. All assets are reported at their historical cost to ensure consistency. B. Only admitted assets are included in the balance sheet based on strict regulatory criteria. C. Non-admitted assets are fully recognized if their market value exceeds liabilities. D. Admitted assets are valued using a blended approach of historical cost and fair value. Answer: B. Only admitted assets are included in the balance sheet based on strict regulatory criteria. Explanation: A. Incorrect. SAP does not mandate historical cost valuation for all assets, so the focus is on admitted assets. B. Correct. SAP includes only admitted assets, which are assets readily available to meet obligations. This conservative approach ensures solvency. C. Incorrect. Non-admitted assets are excluded from solvency calculations, regardless of market value. D. Incorrect. Admitted asset valuation varies based on regulatory guidance and asset type, not a blended approach. Relevant guideline. Oregon-specific financial reporting standards for captives aligned with SAPA, emphasizing solvency through conservative asset valuation. Question 10. Topic: Case studies and practical applications. A newly formed captive in Oregon specializes in providing product liability coverage for its parent company. In its first year, the captive experiences unexpectedly high claims exceeding its premiums. Which action would best ensure the captive's long-term financial stability? A. Increase premium rates immediately to cover the deficit. B. Negotiate reinsurance agreements to transfer a portion of the risk. C. Use existing surplus to pay the claims and maintain current rates. D. Reduce coverage limits to minimize future claims exposure. Answer: B. Negotiate reinsurance agreements to transfer a portion of the risk. Explanation: A. Incorrect. Immediate premium increases may not be feasible or sustainable for the parent company. B. Correct. Reinsurance spreads risk and protects the captive from significant financial losses, supporting stability. C. Incorrect. While surplus can address short-term needs, relying solely on it without risk transfer exposes the captive to future instability. D. Incorrect. Reducing coverage may negatively impact the parent company's risk management objectives. Relevant guideline. Oregon-specific reinsurance rules emphasize using reinsurance to manage unexpected claims and ensure captive solvency. Question 11. Topic: Captive formation. Which of the following is not a common reason for a business to establish a captive insurance company in Oregon? A. To reduce the cost of commercial insurance premiums. B. To gain more control over risk management. C. To avoid state taxes on insurance premiums. D. To access specialized coverage for unique risks. Answer: C. To avoid state taxes on insurance premiums. Explanation: A. Incorrect. One of the main reasons to form a captive is to reduce insurance costs through self-insurance. B. Incorrect. Captives allow businesses to have greater control over risk management by customizing coverage and claims handling. C. Correct. Oregon does not allow businesses to form captives to avoid taxes. The captives must meet regulatory standards and contribute to the state's economy. D. Incorrect. Captives provide specialized coverage for unique risks that traditional insurers may not offer. Relevant guideline. Oregon's tax laws for captives ensure that tax avoidance is not a legitimate reason for forming a captive. It must adhere to sound business practices. Question 12. Topic: Regulatory compliance. Under Oregon law, which of the following is a key requirement for a captive insurance company's annual report? A. The report must include an independent audit of the company's financial statements. B. The report must include a detailed analysis of the parent company's business operations. C. The report must outline specific claims history and underwriting data. D. The report must include an actuarial report on future loss projections. Answer A. The report must include an independent audit of the company's financial statements. Explanation A. Correct. Oregon requires captives to submit annual reports that include independent audits to ensure transparency and regulatory compliance. B. Incorrect. While the report may discuss claims or operations, the focus is on the captive's financial health, not the parent company's business operations. C. Incorrect. A detailed claims history is often included, but an independent audit is a more critical requirement. D. Incorrect. An actuarial report on future losses may be useful, but it is not a mandatory inclusion in the annual report under Oregon law. Relevant guideline. Oregon regulations focus on financial transparency, mandating that captives provide audited financial statements for regulatory review. Question 13. Topic: Solvency and reserves. A captive insurance company in Oregon has experienced a higher than expected number of claims during its first year of operation. Which of the following actions is the most important to ensure the company remains solvent? A. Immediately raise premium rates for policyholders. B. Set aside adequate reserves for future claims. C. Reduce coverage limits to control claims exposure. D. Shift claims payment responsibility to the parent company. Answer B. Set aside adequate reserves for future claims. Explanation A. Incorrect. While increasing premiums may help in the future, it is not an immediate solution to a solvency issue in the short term. B. Correct. Captives are required to maintain reserves to meet future claims and maintain solvency. Ensuring sufficient reserves is critical for long-term financial stability. C. Incorrect. Reducing coverage may help limit exposure but does not solve the immediate solvency problem caused by claims. D. Incorrect. The responsibility for claims payment lies with the captive, and shifting it to the parent company could cause operational and financial issues. Relevant guideline. Oregon's solvency regulations require captives to maintain appropriate reserves to meet future liabilities and ensure financial health. Question 14. Topic: Risk management. Which of the following best describes the concept of retention in the context of a captive insurance company? A. The practice of reinsuring certain risks to avoid excessive exposure. B. The process of retaining premiums within the captive to cover its own claims. C. The action of retaining a portion of risks while transferring the remaining to commercial insurers. D. The decision to reduce the number of policies written to lower overall risk. Answer B. The process of retaining premiums within the captive to cover its own claims. Explanation A. Incorrect. Reinsurance is a strategy to transfer risk, not to retain it. B. Correct. Retention refers to a captive's practice of holding premiums within the company to cover its own claims, rather than transferring large amounts of risk. C. Incorrect. This describes a hybrid approach where part of the risk is retained and part is transferred, but it is not the primary definition of retention. D. Incorrect. Reducing policies could reduce risk, but it is unrelated to the concept of retention in captives. Relevant guideline. Captives typically use retention strategies to manage risk, especially for smaller, predictable losses, while larger, less predictable risks are often transferred to reinsurance companies. Question 15. Topic: Investment and financial management. In Oregon, how must a captive insurance company handle its investments to comply with regulatory requirements? A. Investments must be made only in government bonds to ensure safety. B. Investments must be diversified to minimize risk, but not excessively. C. Investments must focus exclusively on real estate and infrastructure projects. D. Investments must be held in low-risk securities with no exposure to equities. Answer B. Investments must be diversified to minimize risk, but not excessively. Explanation A. Incorrect. While safe investments are encouraged, captives are permitted to diversify their portfolios to meet financial goals and regulatory requirements. B. Correct. Oregon regulations require captives to maintain a diversified investment portfolio to reduce risk, but not to the point of unnecessary complexity. C. Incorrect. While real estate and infrastructure may be part of an investment portfolio, captives must diversify and not focus exclusively on these sectors sectors. D. Incorrect. Low-risk securities are favored, but captives are also allowed to have some exposure to equities for greater returns within regulatory limits. Relevant guideline. Oregon's regulations emphasize prudent investment management, including diversification to balance risks and returns. Question 16. Topic: Governance and management. What is one of the primary duties of a captive insurance company's board of directors under Oregon law? A. To maximize dividends for the parent company. B. To ensure compliance with regulatory and solvency requirements. C. To underwrite all policies issued by the captive. D. To determine premium rates based solely on the parent company's risk profile. Answer: B. To ensure compliance with regulatory and solvency requirements. Explanation: A. Incorrect. Maximizing dividends is not the board's primary duty. The board's responsibility is to ensure the company's solvency and regulatory compliance. B. Correct. The board is responsible for overseeing the company's compliance with all relevant regulations, including solvency and operational standards. C. Incorrect. Underwriting is typically handled by the captive's management team, though the board may approve overall policies. D. Incorrect. Premium rates should be based on the captive's risk and claims profile, not solely on the parent company's profile. Relevant guideline. Oregon law requires that the board focus on ensuring financial stability, regulatory compliance, and appropriate risk management. Question 17. Topic: Claims handling. Under Oregon law, when a captive insurance company faces a claim that exceeds its reserves, which of the following actions is required to maintain regulatory compliance? A. The company must immediately seek an emergency capital infusion from the parent company. B. The company must notify the Oregon Division of Financial Regulation and provide a plan to address the shortfall. C. The company must cancel the affected policies and stop accepting new claims. D. The company must reduce the coverage limits for all policyholders. Answer: B. The company must notify the Oregon Division of Financial Regulation and provide a plan to address the shortfall. Explanation: A. Incorrect. Seeking a capital infusion is not the immediate regulatory requirement, though it may be part of a recovery plan. B. Correct. Oregon law requires that captives notify regulators and submit a corrective action plan if they face solvency issues or claim shortfalls. C. Incorrect. Canceling policies is an extreme step and is not required as the first course of action. D. Incorrect. Reducing coverage limits may not be the most appropriate solution and could damage relationships with policyholders. Relevant guideline. Oregon requires captives to take corrective actions to restore solvency and protect policyholders, including submitting a recovery plan to the Division of Financial Regulation. Question 18. Topic: Reinsurance. Which of the following is a key benefit of reinsurance for a captive insurance company in Oregon? A. Reinsurance allows the captive to increase its premium rates without additional risk. B. Reinsurance enables the captive to transfer part of its risk and stabilize its financial position. C. Reinsurance allows the captive to pay low taxes by reducing its risk. D. Reinsurance requires captives to report fewer claims to the Oregon Division of Financial Regulation. Answer: B. Reinsurance enables the captive to transfer part of its risk and stabilize its financial position. Explanation: A. Incorrect. Reinsurance does not directly allow captives to increase premium rates. Its primary purpose is to share risk with other insurers. B. Correct. Reinsurance helps a captive manage its risk by transferring some of it to another insurer, which helps stabilize the financial position by reducing volatility and exposure to large claims. C. Incorrect. Reinsurance does not directly reduce taxes, as the main benefit is in managing risk exposure. D. Incorrect. Reinsurance does not reduce the need for captives to report claims. The reporting requirements to regulators, such as the Oregon Division of Financial Regulation, remain unchanged. A relevant guideline: reinsurance is a risk management tool that allows captives to stabilize their operations by transferring part of their risk to other insurers, which can help with solvency and financial stability. Question 19. Topic: Captive taxation. Which of the following is true regarding the taxation of captive insurance companies in Oregon? A. Captives are exempt from all state taxes on insurance premiums. B. Captives are taxed based on the premiums written in investment income, similar to traditional insurers. C. Captives are taxed only on the investment income generated from their reserves. D. Captives are not subject to state taxes if their parent company is located in Oregon. Answer: B. Captives are taxed based on the premiums written in investment income, similar to traditional insurers. Explanation: A. Incorrect. Captives are not exempt from state taxes, though there may be certain deductions or credits available depending on specific circumstances. B. Correct. Captives in Oregon are subject to taxes on both the premiums they write and the investment income they generate. This is in line with how traditional insurers are taxed. C. Incorrect. While captives may be taxed on investment income, they are also taxed on premiums, not just investment income. D. Incorrect. Taxation is not determined by the location of the parent company, but rather by the captive's operations and the state's tax laws. Relevant guideline. Oregon treats captives similarly to traditional insurers when it comes to taxation, applying taxes to both premiums and investment income. Question 20. Topic: Formation and licensing of captives. Which of the following is NOT required for a captive insurance company to obtain a license to operate in Oregon? A. Submission of a business plan outlining the company's structure and operations. B. Proof of sufficient capital or surplus to meet regulatory solvency requirements. C. Documentation that the parent company is based in Oregon. D. Appointment of a qualified actuary to assess the risks and pricing of policies. Answer: C. Documentation that the parent company is based in Oregon. Explanation: A. Incorrect. A detailed business plan is required as part of the application process to demonstrate the captive's operational and financial viability. B. Incorrect. Proof of sufficient capital is essential to ensure that the captive can meet its financial obligations and claims, which is a key part of the regulatory licensing process. C. Correct. The parent company does not have to be based in Oregon for the captive to be licensed. Captives can be formed for companies outside Oregon as long as they meet Oregon's regulatory requirements. D. Incorrect. The appointment of a qualified actuary is essential for assessing risks, pricing policies, and ensuring that the captive operates within sound financial parameters. Relevant guideline. Oregon does not require that the parent company be based in the state, but it does require detailed documentation, proof of solvency, and actuarial assessments to ensure the financial soundness of the captive. Question 21. Topic: Risk retention groups. Which of the following best describes a risk retention group? G. Under Oregon law, A and RR. G is a type of captive that can only insure risks for a specific group of related entities within Oregon. B and RR. G is a group of insurers that collectively share risks from different unrelated businesses across multiple states. C and RR. G is a group of businesses that come together to self-insure certain risks, often across state lines. D and RR. G is a type of commercial insurer that operates under the same rules as all other insurance companies in Oregon. Answer: C and RR. G is a group of businesses that come together to self-insure certain risks, often across state lines. Explanation: A. Incorrect. While an RRG may insure risks for similar businesses, it can operate across state lines and is not restricted to related entities within Oregon. B. Incorrect. An RRG is composed of businesses, not insurers, pool in their risks. C. Correct. RRGs are formed by businesses that join together to self-insure risks, often operating in multiple states. They are subject to the Risk Retention Act and must comply with both federal and state regulations. D. Incorrect. RRGs are not subject to the same regulations as commercial insurers, as they are a unique form of risk-sharing entity. Relevant guideline. Oregon recognize RRGs, which allow businesses to share risk, often across multiple states, and they operate under both federal and state regulations. Question 22. Topic: Financial reporting requirements. What is the primary purpose of the annual financial statement that must be submitted by a captive insurance company in Oregon? A. To ensure the captive has sufficient capital and reserves to cover its liabilities. B. To disclose the names of all policyholders and their respective coverage limits. C. To report the financial performance of the parent company. D. To provide a breakdown of the insurance premiums paid to the state. Answer: A. To ensure the captive has sufficient capital and reserves to cover its liabilities. Explanation: A. Correct. The primary purpose of the annual financial statement is to demonstrate that the captive has the financial resources, capital, and reserves to meet its obligations and comply with regulatory requirements. B. Incorrect. While the financial statement will include details on premiums and liabilities, it does not require the disclosure of individual policyholders. C. Incorrect. The statement focuses on the captive's financial health, not the performance of the parent company. D. Incorrect. The focus of the financial statement is on the captive's own operations, not on premium payments to the state. Relevant guideline. Oregon requires captives to submit detailed financial reports to ensure that they have the financial strength to meet claims and regulatory requirements. Question 23. Topic: Regulatory oversight. Which Oregon state agency is primarily responsible for overseeing the operations of captive insurance companies? A. Oregon Department of Revenue. B. Oregon Department of Insurance and Financial Services. C. Oregon Division of Financial Regulation. D. Oregon State Treasury. Answer: C. Oregon Division of Financial Regulation. Explanation: A. Incorrect. The Department of Revenue handles tax matters but is not responsible for overseeing insurance companies. B. Incorrect. There is no specific Oregon Department of Insurance and Financial Services. This is a general term for insurance-related matters. C. Correct. The Oregon Division of Financial Regulation is responsible for regulating the operations of captive insurance companies, ensuring compliance with state laws and financial solvency. D. Incorrect. The state treasury manages state finances but does not regulate insurance companies. Relevant guideline: the Division of Financial Regulation is tasked with ensuring that captives and other insurers comply with Oregon's insurance laws and regulations. Question 24. Topic: Capitalization and solvency. What is the minimum required capital for a captive insurance company in Oregon? A. $250,000. B. $500,000. C. $1 million. D. There is no minimum capital requirement in Oregon for captives. Answer: B. $500,000. Explanation: A. Incorrect. The minimum required capital is higher than $250,000. B. Correct. Oregon requires a minimum capitalization of $500,000 for captive insurance companies to ensure financial solvency and stability. C. Incorrect. $1 million is higher than the required capital for most captives in Oregon. D. Incorrect. Oregon has a minimum capitalization requirement for captives. Relevant guideline: Oregon law sets a minimum capital requirement to ensure that captives can meet their financial obligations. Question 25. Topic: Insurance license renewal. How often must a captive insurance company renew its license to operate in Oregon? A. Annually. B. Biennially. C. Every 5 years. D. Every 10 years. Answer: A. Annually. Explanation: A. Correct. Captive insurance companies in Oregon are required to renew their license annually, ensuring continued compliance with regulatory requirements. B. Incorrect. Oregon requires annual renewal, not biennial. C. Incorrect. Captive licenses are not renewed every 5 years. D. Incorrect. Oregon requires annual renewal, not a 10-year cycle. Relevant guideline: the state of Oregon requires annual renewal for captives to ensure they remain in compliance with all regulations. Question 26. Topic: Risk management. Which of the following is a key function of a captive insurance company in Oregon? A. To act as a reinsurance company for commercial insurers. B. To provide insurance coverage primarily for the parent company and its affiliates. C. To offer insurance to the general public. D. To serve as a subsidiary of an Oregon-based insurance company. Answer: B. To provide insurance coverage primarily for the parent company and its affiliates. Explanation: A. Incorrect. Captives typically do not act as reinsurance companies for other insurers, that they are designed to provide insurance to their parent or related entities. B. Correct. The primary function of a captive is to provide insurance for its parent company and its affiliates, managing risks internally. C. Incorrect. Captives do not typically offer insurance to the public, as they focus on covering the parent company's risks. D. Incorrect. Captives operate independently, not as subsidiaries of traditional insurers. Relevant guideline: captive insurance companies are created to insure the risks of their parent company and its affiliates, often helping reduce costs and increase control over insurance coverage. Question 27. Topic: Tax treatment of captives. How are captives taxed in Oregon? In terms of their investment income. A. Captives are taxed at the standard corporate tax rate on their investment income. B. Captives are taxed at a lower rate on their investment income than traditional insurers. C. Captives' investment income is exempt from state taxation. D. Captives' investment income is taxed as personal income. And so A. Captives are taxed at the standard corporate tax rate on their investment income. Explanation: A. Correct. In Oregon, captives are generally subject to the standard corporate tax rate on investment income, just like traditional insurers. B. Incorrect. There is no special lower tax rate for captives on investment income. C. Incorrect. Captives' investment income is subject to state taxation similar to other corporations. D. Incorrect. Captives are taxed at corporate rates, not personal income tax rates. Relevant guideline: Oregon taxes captives on investment income as corporate income, in line with the tax treatment for traditional insurers. Question 28. Topic: Captive insurance audits. Who is responsible for conducting the annual audit of a captive insurance company in Oregon? A. The Oregon Department of Revenue. B. An independent auditor. C. The captive's parent company. D. The Oregon Division of Financial Regulation. Answer: B. An independent auditor. Explanation: A. Incorrect. The Department of Revenue is responsible for tax-related matters, but does not conduct audits of captives. B. Correct. Captive insurance companies in Oregon are required to have their financial statements audited by an independent auditor to ensure financial accuracy and compliance. C. Incorrect. The parent company does not conduct the audit. An independent third party must be responsible for maintaining objectivity. D. Incorrect. While the Oregon Division of Financial Regulation oversees captives, it does not conduct the audits directly. The audit must be conducted by an independent auditor. Relevant guideline: Oregon law mandates that captives undergo an independent audit to verify financial integrity and regulatory compliance. Question 29. Topic: Claims management. Which of the following best describes the claims handling process for captives in Oregon? A. Captives must handle claims through a third-party administrator or claims adjuster. B. Captives are not required to have a claims handling process. C. Captives can only handle claims if they have a reinsurance agreement in place. D. Claims must be processed by the parent company's insurance department. Answer: A. Captives must handle claims through a third-party administrator or claims adjuster. Explanation: A. Correct. Captives often use third-party administrators or claims adjusters to manage claims effectively and ensure that claims handling meets industry standards. B. Incorrect. Captives are required to have an established process for handling claims, as they are responsible for ensuring claims are paid promptly and accurately. C. Incorrect. Captives can handle claims on their own, even without a reinsurance agreement, although reinsurance may help manage larger claims. D. Incorrect. Claims handling is the responsibility of the captive, not the parent company's insurance department, unless the parent company operates the captive directly. Relevant guideline: Captives are required to have proper claims handling procedures in place, often utilizing third-party administrators for efficiency. Question 30. Topic: Captive insurance management. Which of the following is not a required function of the captive insurance company's board of directors in Oregon? A. Approving the captive's business plan. B. Ensuring compliance with all regulatory requirements. C. Overseeing the claims management process. D. Operating the captive as a subsidiary of a non-insurance entity. Answer: D. Operating the captive as a subsidiary of a non-insurance entity. Explanation: A. Incorrect. The board is responsible for approving the business plan to ensure that the captive operates in a structured and financially sound manner. B. Incorrect. Ensuring compliance with regulatory requirements is a key responsibility of the board to maintain the captive's license in good standing. C. Incorrect. The board must also oversee the claims management process to ensure that claims are handled properly and in accordance with the captive's policies. D. Correct. A captive is typically operated independently and is not considered a subsidiary of a non-insurance entity, though its parent company may be non-insurance. Relevant guideline: The board of directors of a captive is tasked with key governance and compliance responsibilities, including overseeing operations and ensuring regulatory adherence.